Good evening, everyone. It's Hari Swaminathan. It is Feb 8th, Sunday evening, around 6:15 p.m. And there's quite a bit of development in Europe. There's quite a bit of active fighting that started in Ukraine and Russia. So futures are down. I believe over the next week or two, we're going to be driven by a news-driven market, all coming mostly from the Eurozone. So anyway, so one of the things that I think everybody's been questioning, given what's happening with oil prices, is that, okay, you can see in pre-market now, oil is up about a buck or so. But what's how do we play this? Do we think oil is going to go up? Do we think it's going to go further down? My personal opinion, although I don't have a very strong opinion, but I think even though it may go down, we're probably looking at oil bottomed out at around 44, 45 when it went there a week or two ago. Since then, there's been quite a bit of nice climb. Let's go take a look at the charts, and this is I believe it should be a 3-month daily chart. Yep. So it bottomed out around 43 something. And then it's coming up. Now, granted, you're going to see choppiness in oil. There's going to be quite a bit of volatility. But I believe at the 43 level, we probably saw at least a temporary bottom. Chances of it going below 43 look slim at this point because that would just cause chaos in the market. But how do we play this as a trade? And so if you wanted to play oil, this is of course the oil future. So you can't, I mean, even though there are options on the oil futures, I wouldn't recommend unless you know what you're doing, unless you're very clear about options on futures. A much better way to play oil is the ETF, the USO. So USO is the oil fund. It's an exchange traded fund. And so you can see you have plenty of liquidity. Now you see well, the first thing that should strike you is look at the volatility. So it's anywhere from 75 to 50, 47%. So uh, quite a volatile instrument, and we are going to expect pretty big moves here. But what is the direction we take if you feel that oil has bottomed out? And if you look at the USO charts, again, it bottoms out at 16 over here. This is the ETF price, and it's steadily climbed up to 19. However, you can see it's coming down from 30 or even before that. If you go look at a daily 3-year chart, for example, let's look at a 3-year weekly chart. You can see it's coming down from 43. So it's dropped by over 50, 60%. So I think it's going to try to make its way up. And so if you agree with that premise that USO is probably going to try to make its way up over to 25 or perhaps 30 over the next I don't know 6 months, 12 months, then how would you play this trade? And if you were interested in oil, so the first thing you want to do, let's go ahead and take a look at some closer options. So let's go look at the 40 days March expiry. And what I've got here is the volume and open interest. And you can see the open interest on the call side is very, very heavy. And that itself should tell you that people have bought a lot of calls. So which means they're expecting the price to go up. On the put side, there is quite a bit. There is quite a bit. In fact, there are many bearish bets also. Look at the open interest in at the 16 level is 51,000 contracts. And over here, let's see if we see any 51,000s. Nope. So there's actually probably more bearish bets on oil than bullish. Now, it doesn't mean that that's the way it's going to go. We're just trying to analyze what direction we might perhaps take if we were interested in trading oil. Personally, I feel it has hit the bottom, so perhaps there is now more potential to the upside rather than the downside. So let's say if we wanted to play it on the call side, and let's say we have a 12-month outlook. So if we did that, then you want to go all the way to the Jan 16 option series, and let's go take a look at what the outlook is for that. Once again, you see heavy open interest in the on the call side, and for that matter, even on the put side. So it's actually pretty even in terms of the outlook. So half the market is going to be wrong, half the market's going to be right. I would say there's probably there's 133,000 contracts here, which is a pretty strong put position. But otherwise, there's a lot of 26s and 28s over here. But regardless, you can't just make your trade based on that. If you felt oil was going to go up, if you felt USO was going to go up to say 30, and you wanted to buy a call option at the 30 level, it's going for very little. I mean, it's going for just 62 cents right now. And this is an option that is 1 year out, almost a year out. So, you can buy either the 30 call, or you can come in a little closer, let's say 27 call. So if we were to buy the 27 call, what we're looking at is about 1.05. However, we're not quite sure whether this kind of a move will happen now, immediately. There's bound to be choppiness. So in that case, what can we do? We can do something like this. We can come here. Once we buy this, or you can even buy it as one trade. You can buy it as separate trades if you wanted to time this better. If you wanted to buy it as separate trades, then we're spending 1.06 on this. And in the shorter term, we feel that there's going to be a little bit of volatility. It's probably not going to just go up in a straight line. So what you can do is, if you look at the 27 call, what you're getting is about 9 cents. That's not really much at all. So let's say you would look at the 25 call. So if you sold the 25 call, you're going to get 17 cents back. And if by March, if USO doesn't hit 25, then you get to keep the 17 cents. So this is a diagonal. So, and when you analyze a diagonal, you've got to put +2 expirations, because we've got two separate expirations here. And you also want to so this is what the diagonal would look like. And if you just looked at it as one expiration, let me actually bring it in. All right, this is what the diagonal would look like. So between now and March, as long as it doesn't go much past 25. In fact, if you look at the break even, remember, if your short call is losing money, your long call is making money. So if you look at this trade, we have a nice break even up till 30. So I would even argue that you can come even to, let's say, the 24 and get 27 cents credit for this. Now that brings your break even to about 27.5. That's fine. I mean, USO is at 19 right now. So this is a diagonal strategy, and you'll see that the short call is going to lose a lot of money. So let's say by March, which is 40 days away, you pick up 27 cents. Then you do this 4 times, and granted, in April you might not choose the 24 short call. You might choose, depending on where USO is at that point, if you choose the 25 or if you choose the 23, you could do this 2 or 3 times and actually recover the cost of this call option in about 3 months or so. This is obviously a longer term trade. It's a 1 year trade. And once you've recovered the long option price, then the trade becomes a free trade, and you can do that. Now, so this is if you thought in the long run that oil would go up, and so this is a trade that you can play. If you thought it was going to go down, you would do the reverse. So you would buy the long put, which is about a year away, and then you would, in the meanwhile, try to sell shorter term puts and do that. So, but you do need to have an outlook. If you wanted to do this kind of a trade, you have to have an outlook. So, and in our case, this trade right here has the outlook of oil moving up over the next 12 months. But at the same time, we recognize that it's going to be a choppy affair. And in the meanwhile, we try to make our long option a free option, in which case then we give it the maximum probability of making much more profit. So anyway, that's a trade idea. If you have any questions, please send us an email, info@optiontiger.com. Thank you.